Michael Every, the head of financial markets research at Rabobank International. Michael, hi. Thanks so much for joining in on ET Now. I want to talk about the recently concluded G7 meet. Perhaps not the most friendly one that we are usually used to coming in from G7, all allies, of course. What would be your key takeaways from this all-important meet?
Well, I think that's an understatement that it wasn't the most friendly one. It's probably the most unfriendly ones we've seen in years. In fact, if you check social media today, there are suggestions that one of Justin Trudeau's eyebrows has melted off in response to the vitriol that he received from Donald Trump. Clearly, what you're seeing is complete disunity within the G7 between the US and everybody else, making it a G6 at best, which is no longer really a functional grouping. And you have to contrast that, I think, in global terms, with what you saw happening at the Shanghai Cooperation Organization, where we had President Xi Jinping of China, President Putin of Russia, and several other strongmen standing alongside him in complete illiberal unity. So it's a very interesting global backdrop that we see. It's not one that lends itself necessarily to stable financial markets, though, I have to say.
Michael, what's the kind of response are you expecting from countries like Canada, where Trump has accused them of being very dishonest when it comes to trade tariffs? Even Angela Merkel had expressed a disappointment with the failure of having Trump sign the communique. He refused to sign it blatantly. So what kind of a response can we expect now in terms of trade from countries like these?
Well, bear in mind that the German example you just raised, what can they do? Germany has an 8% of GDP current account surplus, an absolutely enormous surplus in both percentage terms and in nominal terms. It's even higher than China's now. So when you have a country like that, which is basically exporting far more than it imports and saving far too much and relying on everybody else to buy its products, what can they do? Of course, they're in favor of free trade. You know, the inverse of that, of course, is countries that run large deficits. And if they're now saying, as Trump is, we don't want to continue running those deficits for whatever reason, well, the exporter obviously is going to sweat and get nervous and continue to talk about free trade. I mean, I think the bigger implication here is that what we saw suggested from Trump is that we're going to get tariffs on autos, that is cars, going forward. He's already suggested, from what we've picked up in the media recently, that he doesn't want to see Germany exporting as many cars to America as it does. And now it would appear he's taking aim at Canada, and you would put in brackets Mexico, which wasn't at the G7 as well. And if that is the case, well, you're going to see NAFTA collapse, and obviously it's being renegotiated at the moment. And you're going to have a major transatlantic trade spat. That in itself obviously is very bad for real business flows, but from a market perspective, what it suggests to me is we're going to see the US dollar move much, much higher than this, and that would be a worry obviously for India on the other end of that trade.
That's what I was going to come to. But before that, while we are looking at this spat taking place, between Germany, Canada, USA, etc., rather against USA, on the other hand, we are seeing some easing of tensions between the US and North Korea. What are your own expectations, come tomorrow at Singapore? It's pretty obvious that the US is going to force complete denuclearization, by the North Korean regime. But what exactly are your own expectations going into this meeting?
Well, first of all, let me say, when you talk to experts on the phone, and by the way, I'm not calling myself an expert, most of the time they have no idea what's going to happen in markets. They have no idea what's going to happen in economics. Then they have no idea what's going to happen in politics. And when we get onto international geopolitics, like potential nuclear conflict, for example, we really have no idea what we're talking about. So, my guess is just a guess, and it's as good as anyone else's in that respect. Clearly, given that Trump set an ultra-hard line saying that he wants to see the North Koreans completely denuclearized, which is something that I don't think they're willing to do, if both sides stick to their guns, this is going to end very badly and potentially, therefore, very explosively. Having said that, I don't think either side really wants that either. So you're probably going to get some form of fudge, I would imagine, possibly the beginning of some kind of very, very long, dragged-out process, whereby North Korea pledges to do some nice kind of things, the US pledges to do some nice kind of things, and tension is de-escalated. Whether or not that's actually going to result in a long-term solution of this problem or not is a different issue. But I have to say, if you contrast it with the other alternative outcome, which is obviously, as I said, a big mushroom cloud on the horizon, that's got to certainly be the better of the two, right?
And Michael, given the backdrop of this all-important meet, everybody across the world will be looking forward to this meet and watching it very closely. Asian markets, a lot of emerging markets in Asian subcontinent will be depending on this. And of course, even during the G7 summit, we saw Trump bring up India amid his negotiations and amid the talks that he had with world leaders. And I'm just quoting him. He said that, this isn't just G7, we have India where some of the tariffs are 100%. And we are talking to many countries, we are talking to all of them, and this 100% leeway that we've given to countries like India is going to stop. So how do you see emerging markets and especially India reacting to developments like these? And of course, given the backdrop of the Kim and Trump summit, which is lined up for tomorrow.
Well, I think emerging markets will be looking, for a risk-on, risk-off move from the Trump-Kim summit in isolation. But if you're then separating that out and talking about trade, this is messy. Look, the U.S. at the end of the day is, for many emerging markets, still their largest market. China may be gradually replacing them, particularly in terms of primary resources. But for finished products, it's still the U.S. you sell to, not China in most cases. So if they're going to be getting more and more protectionist and sealing off their market more and more, that leaves emerging markets in an enormous bind. I mean, who are you going to sell to? And on that basis, as I said, that argues for a much stronger US dollar and exactly the kind of wobble in emerging market FX that we have so far seen over the past 3 months. It suggests it's got a lot further to go. And that in itself risks, precipitating a downward spiral and a lack of confidence. From a geostrategic perspective, if you're an emerging market, scratch your head and think, okay, I'm an export-led economy. Now, that's not true for India, but it's true for many around it. Well, who am I going to sell to if the US is going to close its doors? So it's a very worrying issue.